It's all good.
Got it. And we're live. Phil Tarrant, Tom Panos, Real Estate Exposed. I've been sprung by Tom Panos here. He's just put this headline up on the screen. The year that was. I don't know what he wants me to do, give my predictions about what the year ahead is and recap on 2022. Mate, outside of my pay grade, I know nothing about real estate, but someone that knows a few things is Tom Panos. How are you, mate?
I'm very good. So just wanted to also confirm, Phil, your mic is it sometimes cuts in and out, Phil. Just make sure it's connected there while that audience is building up.
Better? Am I better off doing that?
Yeah, that looks.
Is that good? Can you hear me?
Yeah, that's good.
Well, it's been traveling a bit, this microphone, Tom, and maybe it's getting beaten up and beaten around. I was down in I think I mentioned last time, down in Parliament House, and while I was there, I did a podcast with Senator James Paterson, who's the Shadow Minister for Cyber Security and also the Shadow Minister for Countering Foreign Interference. So had a really good chat with him in Parliament House, and we actually spoke to him around real estate, and there's going to be some stories coming out in REB moving forward, specifically for real estate agents around the issues of cybersecurity. And we're all very familiar with those recent hacks with Optus and Medibank. And only today I saw Amnesty International's been hit by state-based actors, and also foreign interference. Foreign interference, you might not think about it in Australia, and you think it's sort of a Cold War type of thing, but foreign interference, aka espionage, is alive and well in Australia, and it's infiltrating business communities. So, I don't want to be a scaremonger around that, but
so for the average person that's listening to this now, either on the podcast or watching it, they would say, well, how does that affect me? Why should I be concerned? What's that all about? Tell us more.
Well, that's a good question, right? And the cybersecurity, well, that's very, very simple. Every single person in business today, if you're a director or you're leading an organization, if you don't have cybersecurity on your agenda, I recommend you accelerate looking at that, because the spate attacks are increasing. They're getting more sophisticated. The threat is real and it's present, and it's not going to be going away at any point soon. So you need to have the confidence in relation to cybersecurity as a company director that you're satisfying what will be your director duties in protecting your organization. What's the worst thing you want? Well, you probably don't want to be on the front page of the Toowoomba Advocate, if that's such a thing. If you're a Toowoomba-based agent, with all your client details being hacked and released. Real estate agents specifically, and also mortgage brokers, in many ways a soft underbelly for cyber attacks, particularly from criminal-based actors. The theft of deposits and the size and scale and the quantity of money flowing in and around digitally connected devices as through real estate transactions is huge. So real estate agents and mortgage brokers are a very obvious and clear target for criminal-based cyber actors. So you got to be right across this stuff. You need to be satisfied that what you're doing is sufficient to protect your organization, your client's data. In terms of foreign interference, a little bit outside of my knowledge base, but this is the actions, behaviors of state-based actors or proxies of them for influencing negatively or for their gain the economic and the political system in Australia. It happens. It happens a lot inside of migrant communities. And what does it mean for real estate agents and mortgage brokers? Again, it's just potentially the manipulation of the information that you have, or the utility of it, or being used untowards for doing certain things. So the podcast that I recorded with the senator is coming out soon, Tom. I'll make sure everyone within the real estate network can have a tune into it and just get a sense for it. He speaks, that's what he does all day, every day. So he speaks to it very well. But the key thing for me, Tom, is around the responsibilities for cybersecurity inside of real estate and mortgage broking. It's clear. The wake-up call that Australia needed has happened. It's happened time and time again, but I think finally Australia's starting to resonate with it. I think a third of all Australians' details, Tom, have been leaked as a result of these recent attacks on Optus and Medibank et al. So, what does it mean? What does it mean if your information is out there? Well, probably is anyway. To be fair, if you've gone into a pub after a function at 11 o'clock at night recently and you've had to scan your license details, guess what? That information is sitting on someone's secure or insecure server somewhere. So all your information is probably out there. You just got to work out what information needs to be protected.
Yeah. Okay. Well, look, I can tell this subject was lightly touched on late last year. This year is being even more talked about. Before we know it, it'll be stock standard, part of everyone's operating rhythm, that they've got their checklists all done to do the best that they can, and that might not even cover you enough, but it's reducing and
it's reducing the risk, right? You can't reduce your cyber risk to zero. It's impossible. You only need to think about these large corporates being hacked. They've got full-time teams of people protecting their systems and their architecture, but you can't remove your risk to zero. But it's, the analogy I take from it, it's like a good old-fashioned analog burglar. A burglar, they walk down the street and they go to, house number 1, it's all locked, can't get in. Oh, it's too hard, I'll move on. House number 2, all locked up, move in. I'll move on. House number 3, the door's open. They're going to walk in.
Yeah.
So the softest target will typically be hit. This is, look, I just talk to people about this. My knowledge of this area is growing, and from a number of different angles. But in the sense of business, I would direct everyone to the Australian Cybersecurity Centre. Just Google it. There's a thing called, Tom, the Essential 8, and these are the 8 steps that you need to put in place, which is sort of deemed to be best practice around cybersecurity, and what those essential 8 things would do. And these are stuff like, patching your system. So when an update comes, update. If the thing comes on your phone saying the next iOS is available, update it. When a thing in your computer says, update your software, update it. This is sort of essential 8. It's about 2-factor authentication. So when you put your details in, it sends you a thing saying, put this code in on your phone. This is all essential 8 stuff. And if you do that, Tom, it's probably going to protect you 70, 80%. That's called passive defense. And then there's active defense. Active defense is when you go out there and have a look for where your systems may be compromised. And there's companies that can help you out with that stuff. But start at the essential 8, mate. It's probably enough for this chat, because we want to talk about the year that was, Tom. The year that was in terms of cybersecurity, these big hacks. There is a stat going around, Tom, that the time it takes for someone to identify someone nefarious inside of their network is typically hundreds of days. So it makes me wonder how many real estate companies have those people in their systems right now manipulating that data. The year that was, no real headlines around cyber attacks in terms of real estate. But Tom, I would say 2022 is a watershed year for Australian real estate. We've gone from being in the heights of a booming property market. Some capitals, Tom, and I saw a report just the other day, some capitals like Tasmania have grown by 50% from those pre-pandemic levels. They've all come back a little bit, but all capital cities, all regions, despite some of the drops in real estate that we're seeing coming out right now. I think Sydney is about 8.3% since those pre-pandemic levels. It's come back on the basis of 38% growth. The aggregate gain for real estate investors and people with property in Australia over the last 3 years is very positive, and there's not a lot to be complaining about. If you want to look at the real estate market as of May 2022, or probably a little bit earlier, 2022, Tom, the story is softening real estate prices. That's the correction that's taking place right now. But I think the continuity of the Australian real estate market, irrespective of what's happened over the last 8 to 12 months, is strong. And as an investor, mate, I'm still investing in real estate in Australia.
Yeah, well, others say buying the dip and hold. That's the strategy of the best long-term investors. And the dip's here right now as we speak. Don't know how longer it's going to be. I don't think you've got to hurry off and buy before Christmas, but I wouldn't leave it too much into next year. In fact, I had Louis Christopher on talking to our real estate gym members, and he came up with 4 different
report.
Yeah, his boom and bust report. That's right. Yeah. 2 weeks ago, we had him on the day that he released it, and he's got 4 scenarios there. He's not saying this is what the market's going to do. He was saying if this scenario plays out, this is what will happen. If this scenario plays out, this is what will happen. So it's highly dependent on the Reserve Bank and interest rates. Highly dependent on that. The worst case scenario would be to slow up rate rises or bring them to a stop, and then not to be happy with the results, and then to start lifting rates again. That would be the worst result. The best result would be that after the February rate rise, they just say, we're going to sit back and look at the data, and that inflation heads in the right direction, and they just say, yep, good, we're happy. And then hopefully towards the end of next calendar year, that they're so happy with inflation being at a spot where they feel like we can live with that, is to potentially also then lower rates, which would then kick off the next set of increases across Australia. And Phil, that's not that's actually in line with what the last 9 corrections in Australia have been, that they're probably going to be around 20 months to 2 years. And we're well into that now. Like if you ask a lot of the Sydney, Melbourne people, they'll tell you the height was October, November 2021, right? That's changed for other parts of Australia. Queensland's, started to realign a lot later. But Phil, it's been a very challenging year for the real estate industry, because the real estate industry lives off volume. Volumes have been down. Volumes are down. Commissions are down. Income's down. We're beginning to see the casualties. There are certain real estate agents who have decided that they're going to leave being a standalone agent and work within a pod. There are other real estate agents that we're seeing that are leaving the industry completely. So it's been very, very challenging. I saw the mortgage brokers' numbers as well, Phil. There is no question about it. There's a lot less loans being written as a result of it. Having said that, there is a lot more opportunities in refinancing, which we're probably going to see next year. Some people are calling it the mortgage cliff. I'm not quite sure if it's a mortgage cliff. Phil, there's a lot of people that are going to go from 2% fixed to 6% or 6.5% variable in 2023. There's a lot of those people there. Don't know what the impact's going to be. Your view is these people coming off from 2% to 6.5%, is that going to pose a challenge for those people and for their values of their properties?
Yes, is a simple answer. And I think the Reserve Bank is conscious of that. And by memory, I think there are three significant tranches of people coming off fixed rate periods. So we come into the first one, I think sort of the first, second quarter of next year. What I would say to those people who have been living large off the backs of super low fixed interest rates and are going to be reset at a rate that starts with a 6, there are many ways to ameliorate that. And I'd be getting onto it really early, just understanding what you're in for should that happen. And my read of it, Tom, and the market sort of is saying right now, official cash rate circa 3.6% is where it cap out. There is some economists, Tom, saying to your earlier point that maybe that's enough from the Reserve Bank. Maybe what they've done in the 25 basis point rate rise in December will be enough to get us to the top of the interest rate cycle. Personally, I think there's probably another 50 basis points in it, which will probably take place in February and March. There is no interest rate announcement. There's no interest rate sort of decision in January. We'll get a holiday on that. So the Reserve Bank's going to have two full months largely of data to actually see the impact of the rate rises, 8 consecutive rate rises. It's fastest increase in years, the highest it's been in 10 years, the official cash rate. We're going to have 2 months of data to actually see the impact of how these 8 interest rate hikes is going to wash through the spending habits and behaviours of Australians. So it's going to be very important decision come February. I subscribe to your view, Tom. I would rather the Reserve Bank go hard early and then bring it back, rather than doing enough and then just incrementally just keep creeping up. I think that the former is absolutely a better strategy than the latter. And as soon as you get that inflection point of we're pretty much at the top of this rate cycle, is when attitudes towards real estate are going to fundamentally change in Australia once again. That said, serviceability is tighter, and that will shape the price points for where a lot of Australians are operating. All that will happen is that you end up with a greater disparity between this sort of two-speed market. So you're going to have more people operating at the more affordable end, because you're going to have owner-occupiers. You're also going to have first-home buyers, and you're also going to have investors all operating in that same space. So I think you're going to see pressure in those markets earlier than more high value and prestige markets. That's my prediction for 2023. But when you look at 2022 and the year that was, Tom, we've spoken about this sort of quite a lot over the last year or so. It is a unique moment in time in Australian real estate, coming off the back of these accelerated price growths, the COVID pandemic. We'll never ever see these conditions again, Tom. So whether or not it's going to lend itself to the chart that you've shared a number of times over the last weeks around these 9 corrections, if history tells us there's going to be a sharp return to where we left off at the start of this decreasing rate cycle. Again, the big question mark is around these inflationary pressures. Has the Reserve Bank done enough to curb spending? But I think those 2 months, Tom, running into February, you're going to see really how much Australian households are hurting. A $500,000 mortgage, 25 basis points, it's about another $75 a month in terms of repayments on a $2 million mortgage. Now, I think you're up for about another $4 million interest repayments thereabouts from the start of this inflation or this rising rate cycle. So I think a lot of people are hurting a lot more than what they're showing and what the numbers indicate. So prices for 2023, Tom, once we hit that inflection point of rates aren't going up anymore, you're going to see an attitudinal shift and another surge. And whether or not some markets will perform different to others, I think that'll come down to the serviceability requirements. Adelaide's been a star performer over 2022, Tom. That's grown by 40% over the two plus years of the COVID pandemic. So I'd be pretty selective where I'd be buying right now. Not all markets are going to go up in unison, but I'm excited about Australian real estate, Tom. We are in very, very uncharted territory with this, and we can look to history to get a prediction of what the future holds, but there's still a lot of unknowns in there, mate.
Yeah, look, I've said it before and I'm sticking to it. Sydney, Melbourne, if it's not bottomed, it's very close to it. And in fact, some of the results in the last 2-3 weeks, including clearance rates, including unique properties selling at higher than expected, suggest to me that it's probably closer to the bottom than heading to the bottom. I think it is at the bottom. John McGrath has the same view, looking at his own auction numbers in his own company. The Ray White Group, which is the largest group in Australia, their New South Wales figures are the highest clearance rates they've had for most of this year in the last few weeks. So, yeah, all I can say to you, and there's, Mark Sully, who's a client that I auctioned for. I just noticed he's on here as well. He's been selling a lot of properties. But Phil, it doesn't mean we're going to get this incredible bounce all of a sudden, right? It just means that what's happened is people sort of know we're not halfway through interest rate rises. We're towards the end. Number 2, people know that if they bought a home, look at Mark, he's at a listing presentation trying to phone me. Well, that's what picture what this guy's doing, right? Look at this. In a listing presentation trying to phone you, right? He's talking to the vendor and he's trying to book an auction. And all the good agents right now, Phil, they haven't left yet. The good ones are sitting there and they're trying to lock in as many agency agreements as possible to launch in the first week of January. And the reason it's the first week of January, is this simple reason. There's no stock on there. So people are going to be looking around. There'll be nothing on. Everyone's banking. Everyone's banking on properties coming onto the market, right, after February, the Australia Day, right? And you just get a glut of property, Phil. And what actually happens is that you get this oversupply of stock, and then what happens is it softens the price. Whereas if you go early, if you start your opens on the first week of January, well, let me have a look here on the dates. If you go, this is really good advice. CoreLogic RP Data have always said, take economics out, seasonal, sell the first 3 weeks of January. If you do an open home on the 7th of January, on the 14th of January, and on the 21st of January, that's your 3 opens. And if you can sell your property around that period, you're better off doing that than launching your property on the 4th of February, because you're going to be, if you're in Sydney, there'll be over 1,000 properties. If you're in Melbourne, there'll be close to 2,000 properties going on. So that's what I'd be doing, Phil.
Well, you know how to sell.
I'm actually getting booked. Good at it. I've got to tell you, I'm getting booked out doing auctions in January on the Gold Coast, because I'm going to be in Byron anyway. So
who's the best auctioneer up in Byron Bay, Tom? Who does everyone use?
Oh, they don't do a lot of auctions there.
It's all Byron private treaty stuff.
Yeah, Byron Bay is all private treaty. In Queensland, it's funny. Jason Adcock just texted me. He's one of the great auctioneers. Jason Adcock just said to me, over 15 mil in Brisbane, the market is crazy. Crazy.
Who's buying that stuff?
Miners. Cash. Just cash buyers. It's just cash. Yet 1 to 3 million, he says it's just a struggle. Why? Because they're all borrowing. So yeah.
Well, to the point around borrowing, Tom, and we'll chat about that interest rate cliff. There are ways in which you can, if you're on a fixed rate product right now that's going to go variable, when you signed your mortgage documents, there would have been some clause in there that after the fixed rate period will go to the variable rate, less some sort of discount that they've factored in at that point in time. So just don't assume that that's going to be the best rate or the best product or the best bank for you when that happens. Get on the front foot. I'd be understanding now what your cash flow requirements are going to be should you move straight into the rate that they give you. And I'd be speaking to a mortgage broker pretty quickly to try and work out your options. And the likelihood is that moving banks will get you a better deal. New business to banks is getting more favorable rates than current customers. And you sit there and just go, well, that's just madness. Shouldn't they be rewarding loyalty? Guess what? That's the way the banks are orientated. They'll put a whole bunch of carrots in front of people to move them in for new business into their bank. So speak to your mortgage broker. Tom, we spoke about it. Mortgage broker market share is through the roof, and there's good reasons why, because brokers are doing great work. Get on top of it. You know, if you're on a 2.5% fixed rate and you're going up to 6 point something, you're going to have to find that money somewhere. And the good thing is, Tom, a lot of Australians' family balance sheets are the strongest they have ever been, with more savings. A lot of people have money sitting in offsets, this sort of stuff. But that's been eroded. This comes back to the point. We're going to get 2 full months of data when the Reserve Bank meets in February. I think a lot of those savings are being eroded, Tom, and people are going to have to start tightening up the purse strings. So if you're holding property, whether you're an owner occupier or a property investor, the biggest cost connected with it is your mortgage. So get on top of it. I'm going through a refi.
Phil, you're frozen up. So, gang, while he's unfreezing, I'm going to say to you, one thing I've learned about banks is this: when they're chasing you for business, they'll wine you, they'll dine you, I'll take you to restaurants, I'll invite you to things, and once they have you as a prospect and you move to being from a prospect to a customer, that situation is much different. Whereas I actually find with mortgage brokers, if you get a good mortgage broker, they're with you the whole time. A good one's going to be staying in contact with you. A good one's going to be giving you information that's very useful, and not just at the time of taking out a loan. Anyway, team, I noticed that Phil Tarrant has dropped off. So what I'm going to do is I'll just finish off this stream and just say to you, here is my prediction in real estate for 2023, that we're going to come back in the new year, that there's going to be a bit of confidence and energy in January, that we're probably going to have a rate rise in February, and then people are going to sit back to see, is that the last of the rate rises, right? And then what's going to happen is Phil's coming back on here, and then what's going to happen is, so Phil, I'm just telling, as you dropped off there, I'm just telling people, my prediction is we're going to have a good January in real estate. We're going to get a rate rise in February, and then people are going to sit back and watch what's the next move. How much more? Is there one more? You're indicating you think that there is at least one more. And then I think what will happen, Phil, is people are going to wait to see what the Reserve Bank does, because by then they would have had a year of interest rate rises, and there should be an impact to what people's behavior is in the direction that the Reserve Bank has wanted. And after that, I think that you're just going to get a real estate marketplace, more people going and looking, and we're going to move back into a cycle of real estate. I don't think we're going to get this incredible bounce where it's going to go up 10, 15%. By the way, Phil, all that's really happened is in many markets, things went up by 40%, and people are given back 10 or 15% of what appears to have been unsustainable profits. They're still not losing money. They're just giving away some of the profits that were probably artificial due to these unique circumstances we had that meant that physically people only had a limited number of choices of properties to buy, and the demand and supply due to the lockdowns meant that we had this spike in real estate that we may never see again for
it's
many,
really
many years.
It's about putting it in perspective, Tom. If you had real estate, if you owned real estate, owner occupied, property investor, both, whatever, pre-pandemic, and you were able to hold those properties through the pandemic, you've done well. You know, if you've gained 40% and come back 8 or 10%, you're still 30% ahead of the game. In anyone's language, that's pretty good buying. That's pretty good capital growth. The only real issues that you, and this goes to the point about you're not seeing a glut of property on market with desperate sellers, because if you've been able to hold real estate, it's not an issue. Now, if you've refinanced your properties to 80, 90% at the peak of the market when your valuations were the highest, and you've pulled that money out and you've chucked it in an offset, probably not a big problem. But if you've used that money and deployed it into other property at the top of the market, and you've taken on 80% debt, you know, you're probably going to look at the balance sheet and think, well, it's probably a great position to be in. But that's going to be only for a fraction of people, Tom. And it's irrelevant also. If you can hold on to those properties, if you've actually got the cash flow to be able to service those debts, you wait for this real estate period to play out, to plateau, and then move into an upwards trajectory moving forward, you're all okay. So it comes back to the point, Tom, people aren't that distressed that they're flooding the market with properties, which is pushing prices down. And this goes to the point that we spoke about. There's no spring selling season. We're in the middle of summer now. Maybe it's a delayed spring season into summer. I think from your point, Tom, January is probably going to be a big month in real estate. And I'm interested to see whether or not all the agents are going to be either coming back from Aspen or not going to Aspen this year, because I know there's a lot of agents use that time to get out of Australia with family and friends. A lot less money in the bank accounts this year, Tom. Transaction volume down, commission checks are down. I don't know to what percentage. I don't know if you have a read on it, but I think there's going to be a few more real estate agents kicking around in January this year.
Yeah, no, I think a combination of agents not having had a great year, meaning, you know, the big $50,000, $60,000 business class holiday, New York, Christmas might not be there. But the other thing is, Phil, I have to say a lot of real estate agents have actually said we're going to stay local because airfares, I mean, we know about inflation, but, you know, airfares are through the roof. and the Australians are saying, you know what, like as much as we've missed traveling overseas, we're not going to pay $3,000-4,000 to book up to go overseas because airfares are horrendous at the moment. Phil, you're aware of it. You travel. They're just they're far more than the 10-20% that we hear in other products that have gone up in inflation. Some of these things have tripled, Phil.
Yeah, and more. The thing is that there's less flights now, so there's a lot less flights than what there were pre-pandemic. You think everything in aviation is back to normal? It's not. There is a lot less flights out there. Flights are fuller. There's a lot less spare space on flights, and most of the seats now on flights are paid for. Even though you think there's a whole bunch of these sort of classic reward seats with people buying on points. No, good luck trying to find yourself one, and good luck getting an upgrade in this market. Flights are through the roof. A lot of the airlines are trying to recoup losses through the COVID period, and a lot of them will be saying, well, the cost of fuel's gone up considerably, so they need to pass on those prices. So that's the argument. I'm doing less flying purely because of the price. I can't justify it. $1,000 to get to Auckland on a 3-hour flight, right? I'm buying flights to Canberra one way for nearly $500. It's a 30-minute flight, Tom.
Yeah, no, that Phil.
Economy.
I've got a 1:30 appointment. Can we catch up again next week? Have you still got one episode in you?
Mate, we'll keep going. I reckon we got 2 more into us before Christmas, mate.
Beautiful. All righty, Phil, I'll see you next week. To all our listeners and viewers, hang in there. And sun's out, guns out. Enjoy. See you next week.